What did you do yesterday to go from 50 beeps to 25 beeps?
Well, thanks a lot, Tom. Yeah, that's right. When the facts change, you do change. And I think we saw in the data a little bit of softness in the price data. Certainly, we've had softer core CPI readings. And then producer price index usually doesn't get a lot of attention. It definitely got our attention. That was a little bit softer also. It means core PCE inflation is going to be a little bit softer. So I think there's enough softer price and wage data for this Fed to, I think the way they're feeling now is comfortable that they've maybe done enough or getting close to having done enough. I am quite uncomfortable that they've actually done enough here, and I think we're going to see that in some of the upcoming data.
Let's talk about the uncomfortable reality of the x-axis in economics. So you've adjusted for February 1, but the cumulative path out into 2023, does that still give you your high news-making terminal rate?
So we're still at 525 to 550 on the terminal rate, and I would just highlight relative to what I'm hearing Fed officials talk about, relative to what markets are pricing, it would seem to me that that is at the lower end of what would be a reasonable terminal policy rate for this Federal Reserve. So it's very possible, it's our base case that they're getting to this 5.25 to 5.5% range. But just like your previous guest was talking about, if we see wage growth that picks back up again, and we think it will over the course of this year, if we see service inflation that stays sticky, then we may see this Federal Reserve reassessing, is that really the appropriate policy rate to get to? So although we're hearing Fed officials saying we're going to stay the course, and it maybe makes sense to move at a slower pace now to figure out where that rate is, will we really be seeing the policy response that you need to slow down the economy sufficiently to loosen the labor market to bring down inflation?